What happened in 1907 looks dangerously familiar today. Banks collapsing, markets spiraling, people lining up outside financial institutions, desperate to pull out their savings before it was too late. Headlines filled with fear, rumors spreading faster than facts, confidence evaporating in real time. For many Americans today, those images immediately bring one year to mind. 2008, the global financial crisis, the collapse of major institutions, emergency bailouts, a system pushed to the edge. But the panic you're hearing about right now didn't happen in 2008. It happened more than a century earlier. It was 1907. And at that moment, the United States, the fastest-growing economy on Earth, came dangerously close to financial collapse. To understand how it happened, you first have to understand the illusion that came before it. At the beginning of the 20th century, America was booming. Railroads stretched across thousands of miles of land, connecting cities and industries in ways never seen before. Steel mills roared in Pennsylvania. Oil fields expanded across the country. Factories ran day and night, producing everything from machinery to consumer goods. Industrial growth was transforming the nation. Cities were expanding. Immigrants were arriving by the millions. Entrepreneurs and investors believed they were witnessing the birth of a new economic giant. Wall Street became the symbol of that optimism. Investors poured money into railroads, mining companies, steel manufacturers, and energy businesses. The stock market reflected that excitement. New fortunes appeared almost overnight. For many Americans, it felt like the country had entered an unstoppable era of prosperity. But beneath the surface, the financial system had a dangerous weakness. There was no central bank. There was no national institution designed to stabilize markets during crises. There was no coordinated authority capable of injecting money into the banking system when panic spread. Today, that role is played by the Federal Reserve. But in 1907, the Federal Reserve did not exist. Instead, America's financial system was a loose network of thousands of independent banks, trust companies, and private financial institutions. Some were well regulated, others were not. Trust companies in particular had grown rapidly during the early 1900s. They functioned similarly to banks, accepting deposits, issuing loans, and investing funds. But they operated with fewer restrictions. Many of them took greater risks, and towering above much of the financial world was one man: J.P. Morgan. Morgan was more than a banker. He was a financial titan whose influence stretched across railroads, manufacturing, and banking. His firm had helped build some of the largest corporations in America. When Morgan spoke, Wall Street listened. He had already demonstrated his power once before. In 1895, when the U.S. Treasury faced a dangerous gold shortage that threatened the stability of the dollar, Morgan organized a private syndicate that helped replenish the nation's gold reserves. That intervention helped restore confidence in the financial system. By the early 1900s, Morgan had become something rare, a private citizen whose financial power could influence the entire economy. But even his influence couldn't prevent what was about to unfold. In October 1907, the system's hidden fragility finally cracked. The spark came from an ambitious and reckless financial gamble. A group of speculators attempted to manipulate the stock of the United Copper Company. Their goal was to corner the market, buying up enough shares to control the supply and force investors who had bet against the stock to buy it back at inflated prices. One of the key figures behind the plan was financier F. Augustus Hines. The strategy sounded simple: buy large quantities of stock, drive up the price, force short sellers into a financial trap. But the plan failed spectacularly. Instead of rising, United Copper's stock price collapsed. Investors quickly realized that the speculators didn't actually control enough shares to corner the market. Confidence vanished almost instantly, and once investors began digging into the connections behind the failed scheme, they discovered that Hines had close ties to several financial institutions. That discovery triggered the next phase of the crisis. Depositors began questioning whether banks connected to the speculation were safe. One institution, in particular, came under immediate pressure: the Knickerbocker Trust Company, one of the largest trust companies in New York. He also helped secure a massive loan for the New York Stock Exchange, preventing the market from shutting down entirely. In effect, Morgan had become the country's unofficial central bank. A private banker, not an elected official, was coordinating the rescue of America's financial system. Historians still debate the implications of this moment. Was Morgan acting as a hero who saved the economy, or was he protecting the financial system that had made him one of the most powerful men in the world? Either way, many experts agree on one thing. Without Morganese intervention, the panic of 1907 might have spiraled into a full economic catastrophe. Meanwhile, the federal government struggled to respond effectively. President Theodore Roosevelt had built a reputation for confronting corporate power, yet even he lacked the tools needed to manage a crisis of this magnitude. The Treasury Department could inject some funds into banks, but it did not possess the authority or flexibility of a modern central bank.